All right, today we're going to talk about some of our original investment commentary and pieces of research that we found most interesting for the week of January 15th, 2021. And to start, I'm going to just quickly walk through one of the articles that I wrote. The title of that piece was Considerations for Investors Seeking High Dividend Paying Stocks. And actually, Jack, we just recently finished doing our Excess Returns podcast, talking about a few of these issues. I think this article sort of gave us the idea to kind of dive into dividends a little bit more. But what my article was basically highlighting was how dividends are very important for a lot of investors, and a lot of investors seek out high dividend paying companies. But when you look at the yield on dividends over time, they have been falling steadily, particularly since like the 1980s. The average yield for stocks over the last 100 years has been about 4% right now. The yield on the S&P 500 is about 1.6%. So yield has certainly come down. And then I sort of talked about how the decision to pay a dividend is actually a decision made by the company. These aren't like automatic payments necessarily that just all companies pay. It's really a capital allocation decision, and a company can decide to pay dividends, they can decide to buy back stock, they can decide to pay down debt, or they could decide just to retain earnings. But one of the trends that is, and there's a chart in my article where I highlight this, the trend, there's been an upward trend in terms of buybacks and a downward trend in terms of dividend payments. So a lot more companies, for a lot of reasons, are actually buying back a lot more of their stock. And actually in 2017, I believe that line crossed. So we've been on a trajectory where buybacks, or the amount spent on buybacks, is now greater than the amount paid out in dividends, which a lot of investors may not even know. And then I sort of highlighted or found a S&P Global report. And this is similar to what we talked about in the podcast when we looked at some of O'Shaughnessy's data from What Works on Wall Street. But this S&P Global report basically was tracking like the S&P high yield dividend portfolio, the S&P 500 buyback index, the S&P 500 shareholder yield portfolio, and then they compared those portfolios to the S&P 500 index and the S&P equal weight index. And basically what they showed was, while the high dividend portfolio actually beat the S&P 500 and the index, which is a market cap weighted index, and the equal weighted index, the buyback index and the shareholder yield portfolio, which incorporate buybacks, actually beat the high dividend paying portfolio. And then to wrap it up, I sort of talked about this idea of a synthetic dividend, which is basically just, instead of generating income from yield, you're basically, another way you can do it is you can basically sell parts of the portfolio to generate that income over time. So that was sort of a quick summary of the article I wrote. But like I said, we talked about this a lot more extensively, I think, in the Excess Returns podcast.
Yeah, I think the general idea is investors tend to overemphasize dividends, and investors tend to want to buy high-yielding stocks more than maybe they should. And when you take a step back and you say, why am I buying these high-yielding stocks? What are the things I'm trying to accomplish? And can I maybe accomplish those in a different way? You end up with maybe a different way to build a portfolio, or you end up with something like a synthetic dividend where maybe I can generate the dividend and I don't have to worry about buying high yielding stocks. So we talked about that in the podcast, and you talked about shareholder yield in the article, which is a better way probably to look at the way companies can return capital to shareholders. So yeah, we talked about both of those, but I think the general idea is maybe investors emphasize dividends a little more than they should.
The other original piece of content we produced was our podcast on Peter Lynch, which was doing pretty good on YouTube. I mean, it was getting kind of some good views. I think a lot of investors, especially that follow Validea, are interested in the guru models and the strategies we track. So do you want to talk a little bit about what we discussed in that?
Yeah, Lynch is interesting because he's the hardest guru to track probably of the gurus we track. So if you look at the way Lynch actually managed money and you look at the automated version of Lynch, there's probably the biggest difference there. And, we're using what's the strategy that's outlined in One Up on Wall Street. We're using the exact fundamental criteria, but Lynch is somebody who did a lot of other things. He was known for buy what you know, but there was a lot more to it than that. He wasn't just buying what you know. He was also buying what you know and coupling it with fundamentals. And also Lynch, when AQR looked at Lynch, they found that he is probably probably the hardest guru to put into a certain pigeonhole in terms of the factors he was using. He was using a lot of different factors, and factors even in general didn't explain a lot of his return. So we talk about that a little bit too, and how tough Lynch is to figure out, but also some lessons investors can learn from Lynch.
Yeah, okay, that's a good, interesting sort of set of thoughts on Lynch. I think people will enjoy that podcast if they get a chance to check it out. And what was the most interesting article that you sort of read this week on the blog?
The most interesting article I read was an article about intangible assets and value investing, because one of the biggest issues a lot of us that are value investors have been looking at recently is, are our value models broken because of intangible assets? So if I'm looking at the price to book of a stock and the book value doesn't include these intangible assets like brand and technology, if you think about a company like Google, those are the majority of their value. They're not like, it's not a small thing we're missing. We're missing a huge part of it. And so the question is, are we missing something here by not including intangible assets in our models? And is that the major reason, or one of the major reasons, value has struggled in the past decade? And what they did in the article is they looked at other countries, because one of the things about the United States right now is we have a lot of technology companies. We have a lot of companies with tons of intangible assets. But when you look at other countries around the world, they don't have that, or they have a lot less of that. So what you would expect, if that's the case, is if intangibles is to blame here, you would expect value strategies to struggle more in the United States, where there are a lot of these intangible assets, and value strategies to struggle less in some of these, mineral or, resource rich countries where maybe they have, different types of markets where intangibles are not as important. And what they found in the article is that's not the case. Value has struggled pretty much across the board in every country. And so that might be a reason to think that maybe intangible assets are not as much to blame for value's underperformance as many of us thought.
So I wonder, in those other countries, though, value has struggled relative to growth. So there must be some growth-like companies in those other countries that are attracting capital. Or, one of the things, and I don't know the statistics behind this, I know, there's a lot more, I think, foreign investment in U.S. companies. And I think these stock markets, and we know this because we have some partners in India and also South Africa that are giving investors, retail investors, the ability to actually invest in U.S. companies. So I wonder if this cross-border flow of capital somehow plays into that could be looked at in the future. It's just interesting to think about.
Yeah, you're right. There are less growth type companies in those other countries, but there are growth type companies. And this is something that's really difficult to figure out. I mean, when you get a period where something like value struggles for a long time, everybody wants to come up with every explanation. And, we've written some articles where we've looked at intangibles or what the Fed is doing. And there's arguments on both sides of all these things. I mean, there's certainly, it's not fair or not reasonable to try to value Google without including its intangible assets, because, what is Google without its intangible assets? It's a bunch of servers and some buildings, and, there's no reason to value Google that way. But when you get down to the really cheap stocks, they have far less intangible assets. So you can argue, make a stronger argument that down at the bottom of the barrel with the cheapest stocks, maybe intangible assets are, and that's where value strategies operate, maybe intangible assets are not as big of an issue down there as they are, trying to value Google or Amazon or something like that.
Yeah, so I always love Jason Zweig, who's a columnist for the Wall Street Journal. I mean, his articles are, I have a handful of guys that I try to read every one of their articles. And Zweig writes the Intelligent Investor column for the Journal. I think it comes out, it's either Friday night or Saturday morning. Anyways, I always tend to catch it on the weekend. But he wrote an article, and I thought the headline for this was really catchy. I don't think he's the headline writer. I think an editor did this, but he says, "I'll take Tesla for $1, please." And so he kind of used that kind of grabs your interest. But what he was really talking about is fractional shares. Now, a lot of investors might be familiar with this, but some of you might not. There's been sort of this development, and it's actually, investors have had the ability to buy fractional shares for a long time, but a lot of these major brokers, Fidelity, Charles Schwab, Interactive Brokers, I'd say in the last year, and it's kind of on the heels of what I think Robinhood sort of forced them to do, zero commissions and being able to buy sort of slices or pieces of stocks. So, you don't need, it used to be, if you wanted to buy a share of Google that trades at $200, you'd have to buy one share of Google for $200. And obviously, the more expensive stocks get, if you have to buy one share, the more money you have to put up. I think Tesla's somewhere around, I don't know what, $700 or something. Obviously, Berkshire Hathaway A shares are in the hundreds of thousands of dollars. So, buying one share of those is like sticker shock to some investors. But now through this fractional share development, you have the ability to buy, small slices of stock. So if you want to spend $10 and buy $10 worth of Tesla, which is, less than whatever 1% of its per share value, you have the ability to do that. And different brokers have kind of implemented it in different ways. But what Joao was talking about is there's a lot of benefits to that. You can, cost effectively build diversified portfolios with that. There's this whole trend in direct indexing, which is basically allowing someone to build an index, and you can do that through the use of fractional shares. It's kind of, democratizing, if you will, investing. And I think a lot of young investors are probably investing this way. And by the way, we, through our separate capital management firm, we trade our clients' accounts at Folio Investing, which is recently purchased by Goldman Sachs. And so Folio, for at least almost 20 years now, has been developing and offering the ability to buy partial shares. And because we run these model portfolios, if we want to run a 10 stock model portfolio and allocate 10% to each holding, you can easily and efficiently do that at Folio. And the way that you're able to do it is through this fractional share buying and selling. However, like all things in life and investing, it doesn't come without risks. And I thought that, the one point he brought up that is, I think, a potential downside. I think there's two, but the one he highlighted, which is this concept of nano monetization, which is what casinos and sport betting platforms use when they kind of break a myriad of opportunities or an event into a myriad of opportunities for speculation. So if you think about it, through this slicing and dicing of all these shares, it makes investing potentially, or it can make investing potentially more like a gaming sort of exercise, and which is much more of a speculative way of investing than, let's say, investing, like you want to invest because you want to have ownership in the company that you're investing in. And just to finish this before I let you comment on this, Jack, because I know you had some thoughts. There was an article just in the Wall Street Journal today. I sent it to you, and it was kind of building on this idea. And one of the things that and it was really interesting, you really had to think about it, but it was like, the point of the article was investors are investing based on, all they see is like dollar signs now. Cause it's like, you can put $100 to work. You can put $1,000 to work. It's not really caring so much about the investments anymore, as much as it is like the dollars that you're sort of putting to work, if I'm saying that sort of correctly. And what I was sort of thinking about is like, it is disconnecting from sort of the idea of, when you invest in the stock market, you are buying an ownership interest effectively in these companies. You're entitled to a portion of the future cash flows and earnings that these companies are generating. I think the more and more, and partially due to fractional shares, but partially due to dollar-based buying as well, where you can just say, just buy $100 worth of this and not even think of, it kind of gets away a little bit from sort of the investing, if you will. But at the same time, it's bringing in, millions of new investors into the stock market, which I think is a good thing, because over time you want to get started in the market young and you want to get started early. So I don't know. That was the thing that was the article I found interesting this week.
Yeah, I would put fractional shares in the same bucket as zero commissions. Both of these things are sort of a double-edged sword. They make investing easier and cheaper for people, but when you make investing easier and cheaper for people, you're going to have a bunch of people buying individual stocks who maybe shouldn't. You're going to have people over trading. They're going to have people day trading that shouldn't be day trading. And when you couple that with sort of what's happened in the pandemic, people had some extra time on their hands. The market's done nothing but up since then. You have a situation that could eventually be problematic. And I do wonder if things like, reduced commissions, and I do wonder if the net effect here may be more negative than we think. Because if we are encouraging trading and we are encouraging people to maybe take more risks than they should, the net effect may not be as good as we hope it would be in the long run. And like you mentioned when you were talking, if investing becomes a casino where people don't care, don't even understand what it is they're buying, can't tell you anything about the companies they're buying, can't tell you anything about their fundamentals, you eventually end up with a problem, because these stocks are eventually going to go down, and these people are all just going to sell the stocks and they're going to lose money. And you want to have some idea, whether you're buying index funds or whether you're buying individual stocks, you want to have some idea what your strategy is, and you want to have some idea what you own. And this maybe is getting us a little bit away from that.
Well, guys, we hope you find these weekly summary quick podcasts helpful, and we'll see you next time. Thanks for listening.
Thank you.
If you'd like to keep up on the research, writing, and curation we're doing at Validea, please go to blog.validea.com to learn more and stay updated. You can follow Jack on Twitter at @PracticalQuant and follow me on Twitter at @JJCarbonneau. Thanks so much.
Justin Carbonneau and Jack Forehand are principals at Validea Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Validea Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validea Capital.